Let's talk about cash flow. One of the areas that I see businesses struggle with is managing accounts receivable effectively. What is accounts receivable? When we provide a service to our customer or we sell a product to our customer and we wait for them to pay us at a later date, we send an invoice, we wait for them to pay us at a later date, we now have accounts receivable. It's an asset that entitles us to a future payment. The problem with that is we're laying out upfront costs, payroll, equipment, raw materials, whatever it is, we're incurring cost upfront, and then we have to wait for our customer to pay us. A time lapse between money that we spend, money that we lay out upfront, and money that we receive from our customers. There are 3 simple steps that if business owners would focus in these areas, it can drastically improve their cash flows. The first one is establishing clear payment terms and enforcing them. The second part of that is the hardest. It's easy to establish payment terms. When we send invoices to customers, when we sign a contract, we tell them, hey, we'll give you 15 days to pay. We'll give you 30 days to pay or 45 days to pay. That's easy. The hard part is actually enforcing that because we don't want to damage the relationship. We don't want to be too pushy. Sometimes our customers are significantly larger than we are, and we feel like we don't have the authority to push them into paying in a timely manner. And so what I encourage our clients to do is once they establish those payment terms, they have to have a consistent process of following up. One of the things you can do is include a late payment penalty in your contract language. And then when you send those invoices, you include that language on your invoice that says, if you don't pay our invoice within the agreed upon time frame, 15 days, 30 days, whatever it is, then we're going to add a payment penalty, 3%, 5%, 10%, whatever it is. I've seen payment penalties as high as 10 or 15%. And so you make that clear up front. And then when you follow up on late payments, you enforce those late payments and you tell your customers you have to pay not only the invoice, but now you owe me a late payment fee. The second thing that we encourage our customers to do, our clients to do, is to have a consistent invoicing process so that those invoices are sent out as quickly as possible. And that could be as soon as the job is done, the invoice goes out to the customer. It could mean invoicing ahead of time. It could mean requiring an upfront payment from our customer. We require a deposit. We require 50% payment upfront, whatever it is. The faster we get that invoice out to our customer, the faster we'll get paid. And then the third step that we encourage our customers to focus on is being proactive with collections. It's not enough just to send an invoice. It's not enough to automatically email out an invoice to a customer. We all know inboxes get full. We tend to ignore invoices that get buried down at the bottom, or we tend to ignore invoices where there's no follow-up. But if we have a process of consistently following up and consistently reaching out to our customers to make sure that we get paid, then that'll help us to speed up that collections process. Some of those steps can be automated. So a lot of accounting software has built-in processes where we can send reminders to customers at regular intervals. And that's great, and we should do that. We should send statements to show what the outstanding balances are. But sometimes it's as simple as picking up the phone and calling a customer directly. That can be done by the accountant or the bookkeeper. It could be done by the salesperson. It could be done by the business owner. It just depends on the size and structure of the organization. I hope that's helpful. Keep in mind those 3 simple steps. Establish clear payment terms and enforce them. Invoice as quickly as possible or immediately when work is performed. And implement a proactive collections process.